In this video, we're just going to kind of take up some of the big ideas in these cases 1, 2, and 3 from our first kind of analysis, financial analysis activity. So if you recall, these were the cases. There were 3 of them. So we're going to talk about them in turn. The first one, you were working for Lily, and Lily went and bought a car, and she paid for that car with the business funds, and it was going to be a personal car. So the question was, is Lily correct in her assumption? Well, and the key of the question really was this last paragraph, her misunderstanding, right? She was under the impression that she could, do whatever she wants with business funds. And she's absolutely correct. If this is a sole proprietorship, it's legally hers. She can do whatever she wants with the business's assets. But that doesn't mean as an accountant, you can do whatever she wants with the records. If you want to keep your accounting license, you have to follow the rules of accounting. So you can't treat the car as a business asset, because it's a personal asset, and it's devaluing, and the cost associated with the car as she drives her kids to daycare and back and whatever else, those aren't business costs. So she's wrong in her assumption, and the cost principle, it's the business entity gap is the reason, that business entity concept for part B is the reason she can buy the car with her money out of the business, right? She can take that, but she can't record the car as an asset. It would be what's known as a drawings, which we'll get to once we start to talk about transaction analysis, which is next, actually. So let's quickly look at case 2. So in case 2, this business owner had a building that was originally bought for $250,000, but he or she feels now, Giovanni, I guess it's he, feels that it would be worth $400,000. Great. And you know what? Here's where it gets confusing. This matters. No one lends you money based on what your building was worth 50 years ago. So this actually is important. It would be important when you're going to get a loan, or when you were going to sell your business, or sell the home, or the business, or the building, or whatever it is, right? So there are times when this matters as well. If you're taking on a partner, again, it's kind of the same thing as selling the business. When you take on a partner or an investor, right? That investor doesn't care what the building and your assets were worth when you bought them years and years ago. They want to sort of figure out, what is this business worth right now, so that they can come up with a better idea of your equity and the value of the business. However, you can't change the value of the building. Now, under, just FYI, we don't really cover this in grade 11 accounting, but under international rules, you can. So you can revalue long-term assets like buildings and land, but not under Canadian gaps, at least not at the moment. So should you follow his instructions when you prepare the balance sheet and put $400,000? No, and that's the cost gap, right? So the cost and the objectivity principle are the reasons you have to record that building at the purchase cost, historical cost, and it remains at that value for its useful life to the business. But B, would the bank be interested in the current market price? Of course it would be. Because if you don't pay your loan, right? If you don't pay your loan, the bank's going to take the building to sell it to pay off the loan. So the bank wants to know how much it could get if it's had to sell it, to seize it and sell it to pay off your debt. So the answer to A is no, it's because of the cost principle. And the answer to B is, well, yes, because they care about how much it's worth now. Case 3. So if you recall, George was trying to figure out what this business was worth. And the questions were, taking these facts, all these facts into consideration, and applying the cost principle, what is the new balance sheet, and would you pay the $40,000? Okay, so here we've got the current balance sheet for George Harrison Company, and we have these sort of conditions that were explained in the case. And the first one is the value of the land in the building were thought to be $350,000, and they also predict that they'll go up. Yeah, great. Based on historical cost, it doesn't matter. George agrees to pay off the company's $30,000 bank loan using personal funds, which is basically an investment from outside the business in. So that will eliminate this bank loan. So let's just start with that, because that is an actual transaction. So this bank loan will go away, and this will become $35,000. Now we still balance, and we have no bank loan, and the equity business is $35,000. So now we're looking for an investor. In return for the $40,000 cash, the company will create a capital account in my name with a balance of $40,000 in it, and you will become an equal partner. All right, so let's do that. Let's put our $40,000 in. So this becomes $41,500, right? And we get a capital account with our cash equity. So I'm just going to use my name. So this is what a partnership looks like. Very much the same as a sole proprietorship. You just have a capital account for each partner. So this will now total this total liabilities plus total equity. And we balance again at 275. So the question is this a good deal? Well, here's the issue. We're getting half the business. That's what we were told for $40,000. But you know what? And the idea was that the assets were $235,000. Of course, now they're $275. And the question is, for $40,000, is half the business? Is it a good deal? Well, the long and the short of it is that you don't actually know. You can't answer. That's the greatest takeaway. Because what if the moment before you bought this business, or the moment before you were offered it, there was $1 million of cash in it that George took out? What if the business had $1 million a year ago, but lost $1 million this year? It was so bad, lost half its customers, lost $1 million. You don't know. How do you know? Remember, a balance sheet is just a snapshot in time, an instantaneous moment. The next transaction will change the value of some of your accounts. So without just knowing, the financial position, assets, liabilities, and equity at a specific moment in time, really isn't useful by itself. You've got to consider it in light of other information such as performance, so like profit. You have no idea. Second, this building, as I said already in this video, when you're an investor and you're looking at becoming a partner, for example, the true value of the land, which is $350, does matter to you. So half of those assets would be almost $200,000. Right? That's the market value of the land and building, or thought to be anyway. Half of that's $200,000. The debt's $200,000. That leaves total equity of about $203,000. Right? Well, if you're getting 40, where's that wealth really lying? Are you getting half that? Because if so, great. But why isn't it in your capital account? Why weren't you given a bonus? Well, because you have to use historical cost. So if you truly are now legally the owner of half of all assets, then this is a pretty good deal. But at the end of the day, as I said, this business could have lost $1 million over the last year. You don't know. You can't decide from this information alone. And that's really the most important thing to remember. You must always make your decision with all three statements. Your balance sheet, so your position, your performance, so your income statement, and eventually, once you know, you won't learn it in grade 11, but eventually cash flow statement. But for now, for grade 11 purposes, you need at least the balance sheet and the income statement.